Picture yourself leading the world's most aggressive manufacturing powerhouse. Your automobiles dominate the American market on its home turf. Your consumer electronics fill store shelves across the United States. Your corporations acquire landmarks like Rockefeller Center and Pebble Beach. 8 of the planet's 10 biggest banks are yours. Then, during one weekend, 5 officials meet at a Manhattan hotel and reach an agreement that alters your trajectory before you grasp what you have accepted. This describes Japan after the Plaza Accord of 1985. The same strategy is being prepared for deployment against America's current major economic competitor. The venue has shifted to a Florida estate. The approach remains almost unchanged, and the nation now facing Washington understands precisely what befell Japan and is determined to escape that outcome. Currency functions as a weapon more potent than military hardware. Japan experienced the deepest economic contraction in contemporary times, so severe that its economy today matches the scale it reached in the early 1990s. September 22, 1985 marked a turning point. The early 1980s presented a contradiction. Paul Volcker's Federal Reserve mounted an aggressive assault on inflation, pushing interest rates above 20% in 1981. Those elevated rates made dollar holdings extremely appealing to international investors. Money rushed into America. From 1980 to 1985, the dollar gained roughly 50% against the yen. A powerful dollar appears beneficial. For American producers, it spelled disaster. Exports cost 50% more. Imported goods became drastically cheaper. Domestic manufacturing collapsed. By 1985, the trade gap reached $122 billion. Congress responded with anger. Politicians publicly considered imposing tariffs and quotas on Japanese products. Japan had constructed an economic apparatus without precedent. In the 3 decades after World War II, Japan transformed from wreckage to the planet's second-largest economy. By the early 1980s, Japan controlled industry after industry. Treasury Secretary James Baker grasped the situation. Congressional protectionist laws could demolish global trade. The solution involved managing the overvalued dollar through synchronized international intervention. During spring and summer of 1985, Treasury representatives conducted private negotiations with officials from Japan, West Germany, France, and the United Kingdom. Almost nothing reached the public. On September 22, 1985, finance ministers and central bank chiefs from those 5 nations gathered at the Plaza Hotel in New York. In one afternoon, they produced a statement that would transform the global economy for decades. The announcement said exchange rates should align with economic fundamentals. The actual message: Washington wanted dollar devaluation. The target was 10 to 15%, a managed correction. Reality exceeded all projections. The day the Plaza Accord went public, the dollar dropped 4%. Over the following 2.5 years, the yen's value nearly doubled. At signing in September 1985, $1 purchased approximately 240 yen. By 1987, $1 bought approximately 120 yen. A Japanese manufacturer, receiving 240 yen per dollar, now collected only 120. The pricing advantage driving Japan's export success was halved. Japanese products priced themselves beyond reach. Japan entered Endaka, a phase of severe recession driven by the strong yen. The story's most critical shift happens here. The Bank of Japan, observing export contraction, responded as central banks do during slowdowns. Between 1986 and 1987, they reduced the benchmark rate from 5% to 2.5%. The goal was countering yen appreciation through domestic stimulus. Nobody predicted how cheap credit would affect asset markets in a speculation-ready nation. After the Bank of Japan cut rates and maintained them low, money flooded into stocks and property. What emerged was among the most extreme financial bubbles in recorded history. The Nikkei index rose from around 13,000 to 38,916 on December 29, 1989, almost tripling across 4 years. At maximum, the Tokyo Stock Exchange represented over 1/3 of worldwide stock market value. Textile manufacturers sold at over 100 times earnings. Fishing operations traded at 319 times earnings. Property markets became more detached from reality. By 1989, Japan's aggregate real estate reached roughly 2,000 trillion yen. At its peak, Japan's land value totaled approximately 4 times all United States land value. The Imperial Palace grounds in Tokyo reportedly equaled California's entire property value. Tokyo's 240 square miles exceeded the worth of all American land combined. An estimated 40 to 50% of corporate profits came from financial bets rather than actual production. Corporations purchased Pebble Beach and Rockefeller Center. 8 of the world's 10 largest banks operated from Japan. This could not continue. In 1989, the Bank of Japan became concerned about speculation. It started raising rates. Over 12 months, it raised rates 5 times, driving the benchmark to 6%. The impact was devastating. The Nikkei peaked December 29, 1989. By August 1990, it had dropped to half. Real estate followed harder. From 1991 to 2001, land prices fell approximately 70%. The wealth elimination was unmatched. The banking sector lay destroyed. Insolvent banks financed insolvent firms. Capital remained trapped in failed loans. Banks could not lend. Companies could not invest. Households stopped consuming. From 1991 to 2003, Japan's GDP expanded at only 1.14% yearly. America grew 3 times faster. In 1989, 32 of the globe's 50 most valuable corporations were Japanese. By 2018, only Toyota remained in the top 50. The nation expected to control the 21st century spent 10 years stagnant, then 20 more. The lost decade extended to 2 lost decades, then 3. Between 1995 and 2025, nominal GDP contracted from $5.55 trillion to approximately $4.27 trillion. Real incomes dropped around 11%. An entire generation matured in an economy marked by deflation and diminished prospects. The assertive Japan of the 1980s became a warning. How much connects to that Plaza Hotel meeting? The Plaza Accord did not single-handedly destroy Japan's economy 6 years later. It initiated a sequence of policy choices that proved ruinous. Yen appreciation crushed exports. The Bank of Japan slashed rates in response. Those low rates created an asset bubble. The Plaza Accord was the initial trigger. Now in 2025, America runs trade deficits at extraordinary levels. In 2024, the trade deficit hit approximately $1.2 trillion, 10 times the 1985 figure that caused alarm. Stephen Moran, named chair of the Council of Economic Advisors under Trump's second term, released a paper titled A User's Guide to Restructuring the Global Trading System. He outlined methods to weaken the dollar, directly referencing 1985. Observers immediately labeled it the Mar-a-Lago Accord, linking Trump's Florida property and the Plaza Accord. The central approach uses tariffs as tools to force trading partners into currency appreciation. Recognize this? The pressure Japan encountered in 1985 follows the same structure. The country now in Japan's former role is China. China's bilateral trade surplus with America has topped $400 billion annually. The Trump administration has stated clearly that China is the main focus. The critical distinction: China has examined Japan's experience thoroughly and refuses to repeat it. Beijing views the Plaza Accord as the most dangerous framework in modern economic policy. Chinese officials have determined that any deal producing major yuan appreciation would pose an existential risk. They will not accept it. Japan in 1985 was a U.S. security partner, hosting 30,000 American troops. When Washington arrived with demands backed by protectionist threats or security withdrawal, Tokyo had minimal room to decline. China is not Japan. China possesses nuclear weapons, its own military force, independent strategic objectives, and decades of observing America deploy economic weapons against competitors. When American policymakers suggest a Mar-a-Lago Accord, Chinese strategists recognize the trap Japan entered. They have decided against making that error. The tools deployed in 2025 extend beyond diplomatic deals. Tariffs at 145% on Chinese goods exceed anything from the 1985 playbook. The deeper similarity: the root issue the Plaza Accord attempted to solve in 1985 persists in 2025, only vastly enlarged. The Plaza Accord did not wreck Japan alone. Japan's policy errors, excessive monetary expansion through the late 1980s, regulatory failure to limit speculative lending, and slow recognition of bad debt all magnified the initial damage. The transferable lesson: When an export-dependent economy loses price competitiveness suddenly, the reflexive policy response of monetary expansion, rate cuts, and stimulus can generate damage far worse than the original shock. The Mar-a-Lago Accord has not emerged as a formal treaty. China has signed nothing. The geopolitical circumstances that enabled the Plaza Accord no longer exist. The pressures that created the need have not disappeared. They have intensified. What unfolds resembles less a single clean Plaza Accord and more a scattered, messy version of the same impulse. Tariffs as pressure, security commitments as negotiating tools, technology restrictions as industrial strategy. Whether this succeeds, and whether nations caught between experience something similar to Japan's trajectory, will become clear only later. Tokyo remembers. Beijing has analyzed it exhaustively. Now you understand it as well. The genuine caution from 1985, effects unfolded across 3 lost decades, transforming Japanese society in ways still visible today. The question now is whether this represents a repeat, a modification, or something different. The design is recognizable, the magnitude is greater, the players are more prepared, the risks are unprecedented.